Is the settlement of your real property truly equitable in your divorce case? Why real estate net value matters. One of the most seductive moments in a divorce case is the moment when the property division appears to be equal on paper. The house is worth this much. The retirement is worth that much. The bank accounts are divided. The spreadsheet balances. Everyone is exhausted. Everyone wants out, and the agreement looks fair enough to sign. That is exactly when people make expensive mistakes. Real estate is one of the easiest assets to overvalue, undervalue, or misunderstand in divorce because people tend to focus on gross value. But a $900,000 house is not the same as $900,000 in cash. It may not even be the same as $900,000 in some other asset. The real question is not what the appraisal says today. The real question is what the property is worth after debt, taxes, sale costs, repairs, refinancing risk, and liquidity are taken into account. That is net value, and the net value is what actually matters. Start with taxes. A married couple selling a qualifying primary residence may be able to exclude up to $500,000 of gain. A single filer is usually limited to $250,000. That does not mean every divorce creates an automatic tax problem, but it does mean timing matters. If one spouse keeps a highly appreciated home and sells years later as a single taxpayer, the tax may result in something very different from what the settlement spreadsheet suggested or contemplated. Then there is carryover basis. Under federal tax law, many transfers between spouses or former spouses incident to divorce do not trigger immediate tax. That sounds helpful, and often it is. But the spouse receiving the property may also receive the built-in tax problem attached to it. If the property has appreciated significantly, the recipient may be keeping both the asset and the future tax liability. Sale costs matter too. Real estate commissions, closing costs, concessions, repairs, deferred maintenance, and buyer demands can materially reduce what a spouse actually walks away with. Refinancing matters. A spouse who keeps the house may discover that qualifying for a refinance on one income is harder than expected, or that replacing an older low-interest mortgage with a new high-interest loan makes the deal unaffordable. Liquidity matters. You can be awarded the house and still be house poor, with too much wealth trapped in an asset you cannot easily spend. Rental and short-term rental properties add even more complications. Depreciation recapture, income allocation, expense reporting, licensing, HOA restrictions, permits, vacancy risk, and debt service. The answer is not that every divorce needs 5 experts. The answer is that real estate needs to be analyzed honestly before the deal is signed. A good divorce lawyer is not a substitute for a CPA or a real estate professional, but a good lawyer should know when those issues need to be identified and referred out. The question is not, does the settlement look equal today? The question is, will it still be fair after taxes, debt, sale costs, refinancing, and risk are counted? If the answer is no, the spreadsheet is lying to you.